You are watching Options Basics with Carlyle, here on Carlyle Speaks Wall Street.
Options are just like coupons. Just like the coupons you buy in the store. You have your favorite supermarket, Pathmark, Super Stop and Shop. You go and you get a coupon. Bananas for 25 cents. Never mind they're selling for 50 cents. Doesn't matter. You go to the store with your 25 cents coupon and you get the bananas for 25 cents. It's the same concept with options. You have this contract with a fixed price that it doesn't change. No matter what happens, you can get the product for that fixed price. So you have the contract, you have the product listed on the contract, and you have the fixed price. What is an option? An option is a contract that gives the holder of the contract the option, not the obligation, to buy or sell an underlying asset at an agreed upon price at a later date and time. So, for example, I can buy a contract to buy IBM for $10 3 months from now. No matter what it's trading at 3 months from now, I will be able to buy at $10, but I don't have the obligation to do so. If I use that contract in 3 months, I will be exercising the option. That's what you call using an option. To use an option is to exercise an option. If IBM is trading at a price lower than what I have on my contract, then I can choose not to use my contract and to just let it expire. It's no big deal. I don't have the obligation to use this contract. If I want to use it, I use it. If I don't, I don't. The problem is that you're always guaranteed an initial loss because the contract has a price. You pay what's called a premium. Premium is a price that you pay for the contract. So no matter what, you start off negative with that premium that you've paid. Now you're hoping to make money if things go your way. I buy a contract to buy IBM at $10 in 3 months from now. IBM is trading at $20 right now. If in 3 months from now, IBM is trading at $30, and I have this contract that I bought 3 months ago to buy IBM at $10, guess what I can do? I can use this contract to buy IBM stock for $10 from the person that sold me this contract. Then I can immediately sell those shares for $30, the current market price. With options, it's a two-way street. With the store coupon, if you showed up at Stop and Shop with a 25-cent coupon for bananas and you had a bunch of bananas and you said, hey, I got these bananas, I got this 25-cent coupon, I want you guys to buy all these bananas for 25 cents. They're going to laugh you out of the store because that's not how it works with store coupons. With store coupons, you're always buying. They're one-sided. It's always buying. With options, you got two ways to go. You got a call option and you got a put option. The easiest way to look at it, you call your lifeline on the game show because you want them to give you answers. You want to receive something. You go to your friend's house and you call out, get me some bananas, because you want some bananas. When you call out, you want to receive something. So you are buying. When you buy something, you're going to get something, right? Now, with a put option, you're putting. Now, think about, if you go to your friend's house and you really can't stand him and you bring some rotten bananas and you put them on his couch. So again, options. You have two types of options. Call option, that's where you're buying. Put option, that's where you're selling. So what's the whole deal? If I think IBM is a great stock and the price is going to go up, but this guy, Jim, who has IBM stock, thinks the price is actually going to go down. Here's the deal. First of all, he's making instant profit by selling me the contract. No matter what I do, no matter what happens, he's pocketing that cash, the premium that I paid for the option. And if that's all that happens with the deal, well, he walks away with that money, he's good to go. Now, here's the next thing. Let's say the IBM stock starts to go down. When it starts getting around the price that is on the contract, I'm going to want to make a decision. I'm going to want to exercise that contract right around the price that I intended to pay for it, while the contract is in the money. That's a term they use with options, where the contract is actually profitable. When you get out of the money, that's when, let's say, the current price of IBM is actually less than the price on the contract. You're out of the money. Because if I were to exercise that option, I would be at a loss. If it's trading at $5, I've got a contract giving me the option to buy at $10, $5 over market value. Who would do that? That's crazy. So I'm going to let it expire. The guy that sold me the contract, he walks away with the money. Maybe he wants to hold on to the stock. He thinks it's going to come back up. He's good to go, but he made some money off of me. I gambled. I lost. He won. That's the way it works.
Guess what? You are now the stock options expert. You know everything there is to know about stock options. Not really. There's a lot more to stock options, so I'm going to be doing a lot more videos on the topic. So you definitely want to subscribe to the channel so you can get notified when I upload new videos. And if this video was helpful for you, I would really appreciate that you subscribe to the channel, thumbs up the video, and share it with your friends and colleagues. It takes a lot of time and effort to make these videos, so it's critical that you guys support the channel. Really, really appreciate it. Much more great stuff to come. You're watching Carlyle Speaks Wall Street right here on the Fixed Protocol channel.